two networks. One question everyone keeps asking the wrong way: which one makes you rich? Isn't actually the right question, because that framing assumes both of these assets are playing the same game, competing for the same outcome on the same timeline. They're not. And once you see exactly how differently they're actually positioned, the real answer isn't shocking because of some hidden number. It's shocking because of how badly mismatched this comparison actually is once you strip away the fact that both of these happen to be tokens trading on an exchange. Let's start with the numbers. Stated plainly, no spin, Flare trades around 0.6 of a cent, with a market cap sitting near $519 million, down 96% from its all-time high of 15 cents, reached back in January of 2023. Canton trades around 10 cents, with a market cap sitting between $3.70 and $3.9 billion, down roughly 50% from its all-time high of 19 cents reached this past February. Canton's market cap is currently somewhere between 7 and 8 times larger than Flare's. That gap alone should tell you this was never a fair fight in terms of where institutional capital has already decided to sit. But the gap in market cap isn't even the most important difference between these two assets. The most important difference is what's actually driving each one. And that's where the real drama in this comparison lives. Consider what those two drawdown percentages actually represent in terms of market conviction. A 96% decline sustained over 3.5 years reflects a market that has had enormous amounts of time, multiple full market cycles, and countless opportunities to reassess Flare's value upward, and has largely declined to do so. At scale, a 50% decline over roughly 6 months. By contrast, reflects an asset still very early in its price discovery process, where a single dated catalyst landing on schedule could plausibly move the needle in a way that's far harder to imagine happening for an asset that's already had years to prove itself, and hasn't. That's not a guarantee of anything. It's simply a different stage of the same broader story. And treating both assets as though they're at comparable points in their own life cycle is exactly the kind of surface level comparison this video is trying to avoid. Here's the fight happening inside Flare's story right now. On one side, the believers, and their case is built on real, specific developments to point to. Centaura recently endorsed FXRP, Flare's wrapped XRP asset, as eligible collateral, which matters because it opens the door for XRP holders to use their tokens as collateral for RLUSD loans without ever leaving the broader XRP ecosystem, extending Flare's interoperability thesis into genuinely practical territory. Valor launched a regulated exchange-traded product tied to Flare back in June, giving traditional investors a compliant, regulated way to gain exposure to this asset without touching a crypto exchange directly. These are real, verifiable developments, not vague promises, and they represent Flare actually executing on its core interoperability pitch, pulling external data and value onto blockchain infrastructure in a way regulated products and DeFi protocols can build around. Think about what the FXRP collateralization development actually unlocks for the broader XRP ecosystem, because it's a more meaningful piece of infrastructure than a single headline conveys. Historically, using XRP as collateral for a loan denominated in a different asset has required either a centralized lending platform or accepting custodial risk by moving tokens off-chain entirely. Flare's interoperability infrastructure lets that collateralization happen without XRP holders needing to trust a third party with custody, extending genuine DeFi functionality to an asset whose own base layer wasn't originally built with that kind of composability in mind. That's a real technical achievement, and it's exactly the kind of unglamorous infrastructure work that rarely trends but genuinely expands what's possible for the broader ecosystem Flare is trying to serve. On the other side of Flare's story, the skeptics, and their case is built on a chart that simply refuses to cooperate. 96% down from an all-time high reached over 3 years ago is not a healthy correction. It's a sustained, multi-year bear market that most assets never recover from in any meaningful way. Recent price action has been described by analysts tracking it closely as largely a beta move rather than flare-specific strength, meaning when the price moves up, it's mostly because the broader crypto market is moving up, not because of anything genuinely unique happening at the flare level. That's a critical distinction, because it means even the good news landing on this asset hasn't been enough to generate independent momentum separate from whatever Bitcoin happens to be doing that week. That's a genuinely harder problem to solve than simply landing more partnerships, because it requires convincing the market that flare-specific fundamentals matter enough to move the price independent of whatever the broader market happens to be doing that week. Now, here's the fight happening inside Canton's story, and this is where the drama shifts into an entirely different register. On one side, the believers, and that case is built on the single most significant institutional development in this entire comparison. The Depository Trust and Clearing Corporation has scheduled a broader rollout of its services on Canton for October of this year, following planned institutional deployments across payments, settlement, and tokenized deposits that were already underway in the first half of 2026. In the same window, Franklin Templeton joined Canton as a super validator, deepening its commitment and directly strengthening the network's security and governance. This is not a marketing partnership. This is the entity clearing the overwhelming majority of U.S. securities transactions, scheduling a real, dated rollout within months, backed by one of the largest active asset managers on the planet running direct infrastructure. That's what it actually means for Franklin Templeton specifically to become a super validator rather than simply issuing a fund product on Canton's infrastructure. A super validator role requires ongoing technical resourcing, direct participation in the network's consensus mechanism, and genuine operational accountability for network security. That's a meaningfully deeper form of commitment than a fund manager simply listing a tokenized product and hoping it finds demand. It means Franklin Templeton's engineering and risk teams evaluated Canton's infrastructure closely enough to justify taking on that operational responsibility, a decision that doesn't happen quickly or casually at an institution managing the scale of assets Franklin Templeton oversees. On the other side of Canton's story, the skeptics, and their argument is genuinely uncomfortable because it's not really about the fundamentals at all. Canton fell nearly 5% on a single day in early August, described explicitly by market coverage as a disconnect from bullish news, landing during a broader Layer 1 sector volume drop. A prominent analyst covering this asset warned of a bearish chart pattern targeting a drop toward roughly 11 cents in support, with negative derivatives data weighing on sentiment, even as the institutional story continues strengthening. That's the exact same pattern we've now seen play out across nearly every asset in this entire comparison series. A market that hasn't caught up to what the fundamentals are actually saying, sitting there, verified, dated, while price action tells a completely different story in the short term. That specific detail, the token falling on the exact day its institutional case kept strengthening, deserves to be sat with rather than rushed past, because it's genuinely one of the clearer examples of price and fundamentals moving in opposite directions that this entire body of comparisons has documented. It's not simply that Canton's price failed to rally on good news. It actively fell on the same day Franklin Templeton's super validator commitment was being reported. That kind of disconnect either represents a market inefficiency waiting to correct, or it represents traders who understand something about near-term risk that the institutional headlines aren't capturing. Both readings deserve to be taken seriously, and pretending that disconnect doesn't exist would be dishonest. Now, here's where the arbitrage in this entire comparison actually sits, and it's the part almost nobody covering these two assets side by side has bothered to lay out clearly. Canton's market cap, even after a 50% drawdown from its all-time high, sits at roughly 7 to 8 times Flair's. But Canton's most significant institutional relationship, DTCC, an entity clearing the overwhelming majority of U.S. securities transactions, dwarfs anything currently sitting behind Flair in terms of scale, specificity, and dated commitments. Flair's institutional story, real as it is, consists of a collateral endorsement and a regulated investment product from a mid-sized issuer. Canton's institutional story consists of the actual plumbing of the U.S. financial system, scheduling of real, dated rollout within months, backed by one of the largest active asset managers on the planet running direct infrastructure. That's the mismatch. If market capitalization were purely a function of institutional backing quality, Canton's premium over Flair should arguably be far larger than 7 or 8 times. Given the difference in caliber between Centaura, approved this as loan collateral, and DTCC scheduled a production rollout of its own clearing infrastructure. The fact that the gap isn't larger tells you the broader market hasn't fully priced in just how lopsided this specific comparison actually is. Thus the arbitrage, not a hidden number, not a secret catalyst nobody's heard of, a genuinely underpriced gap between what these two networks have actually secured from real institutions and how the market currently values that difference. Push on why that gap exists in the first place, because understanding the mechanism matters more than simply noting the mismatch. Part of it is genuinely explained by Canton's youth as a publicly traded asset. Launched less than a year ago, it simply hasn't had the same amount of time for institutional narrative to fully translate into broad market awareness and corresponding price discovery. Part of it is explained by market attention being a scarce resource that gets allocated unevenly, often favoring assets with longer track records and more established retail communities over newer, more institutionally focused networks that haven't yet built the same kind of retail-facing narrative momentum. And part of it, frankly, is that DTCC's own announcement, while genuinely significant, is the kind of institutional-grade news that doesn't generate the same viral social media attention as a price prediction or a meme-friendly catalyst, meaning it takes longer to fully permeate the broader market's awareness, even when the underlying substance is more significant than almost anything else being discussed in the specific comparison space. Let's be honest about the other side of this comparison too, because Canton carries real risks. Flair simply doesn't have in the same form. Canton launched publicly on October 31st of last year. It is a genuinely young asset with a limited trading history and a market still working out exactly how to price an unlimited supply burn mint token tied directly to network usage, rather than a fixed circulating supply. Flair, whatever its price struggles, has been trading since 2023, giving the market considerably more time to establish where its floor genuinely sits. Newer assets carry structurally higher uncertainty, regardless of how strong their institutional backing looks on paper, simply because there's less historical data to confirm that backing translates into durable price support over multiple market cycles. There's also a fair question worth asking about Canton's tokenomics that doesn't apply to Flair in the same way. Canton has no maximum supply. Its burn mint equilibrium model means new tokens continuously enter circulation, tied to network usage, with total mintable supply over the first 10 years targeted around 100 billion cc, an amount more than double what's currently circulating. That's a meaningfully different supply dynamic than Flair's structure, and it means Canton's long-term price trajectory depends not just on institutional adoption continuing to build, but on that adoption generating enough burn activity to offset the ongoing issuance schedule. Flair's inflation schedule, while also a real factor, follows a more established, better understood pattern given its longer trading history. Now, here's the part of this comparison that deserves to be stated without hedging. because the evidence genuinely supports a clear conclusion rather than a wishy-washy "it depends" answer. Flair's institutional case, real as it is, remains built on developments that expand functionality within the existing XRP and DeFi ecosystem. Useful, meaningful, but fundamentally supporting infrastructure rather than core financial market plumbing. Canton's institutional case is built on the literal infrastructure that clears trillions of dollars in U.S. securities, transactions, choosing to route a scheduled, dated portion of that activity through this specific network, validated by one of the largest asset managers on the planet, taking on direct operational responsibility for network security. Those are not comparable tiers of institutional validation, regardless of how similar these two assets might look. On a screener, sorted by percentage drawdown from all-time high, the defiant truth this video is built around is this. The question, which one makes you rich, was never going to have a satisfying answer. Because it's the wrong question for a comparison this lopsided. The right question is which of these two networks has actually secured the kind of institutional commitment that historically precedes durable, structural repricing rather than a short-term speculative pump. And on that specific question, sitting across from an entity that clears the majority of U.S. securities transactions on a dated, scheduled rollout is simply not a fair fight against a collateral endorsement and a regulated ETP, however real and valuable that second set of developments genuinely is on its own terms. Canton's price hasn't caught up to that gap yet, evidenced by a nearly 5% drop on the exact day its institutional story kept strengthening. Flair's price reflects a market that's had 3 years to price in everything it currently knows about this asset, and it's still down 96% from its peak. That gap between institutional reality and current price is not going to close itself quietly. It's going to close because DTCC's October rollout either lands on schedule and forces the market to finally price Canton's fundamentals correctly, or it doesn't. And the skeptics currently pointing at Canton's bearish chart pattern get to say they saw it coming. Either way, the outcome gets decided by verified, dated, institutional scale events, not by which asset has the better marketing this week. And that is exactly the kind of comparison this entire series exists to make plain. Instead of leaving buried under a title built to generate clicks instead of clarity. That's the actual answer stated without hedging. This was never a fair comparison in the first place, and pretending otherwise for the sake of a balanced-sounding conclusion would betray the entire premise of laying out the evidence. Honestly, these two networks is currently backed by a piece of institutional infrastructure that has no real precedent in this entire ISO 20022 category. The other is doing genuinely useful, real work, extending functionality within a narrower ecosystem at a scale that simply doesn't compare. The market will eventually reflect that gap correctly. It hasn't yet. That's not a shocking twist manufactured for a thumbnail. That's just what the verified data, laid out honestly, side by side, actually shows. This video is for educational and informational purposes only. Nothing here constitutes financial, legal, or investment advice. Always do your own research and consult qualified professionals before making any financial decisions. If this gave you a clearer, more honest read than the title promised, hit like on this one. It tells the algorithm to put real evidence-based comparisons like this in front of people who are tired of clickbait framing with nothing solid backing it up. Subscribe if you want the follow-up the moment DTCC's October rollout actually lands, because that single event is the clearest test this entire comparison is going to get. Share this with the person who's been treating this as a coin flip decision between two similar assets without realizing how lopsided the actual institutional backing is once you lay it out side by side. Drop a comment and tell me straight, do you think Canton's price catches up to its fundamentals before the end of this year, or does the bearish chart pattern win out, regardless of what DTCC delivers on schedule? Two networks, one honest comparison, and a gap the market hasn't closed yet. Now you know exactly what to watch for and exactly which piece of news actually determines who was right. Have a great day. If you enjoyed this video, don't forget to like, subscribe to the channel, and be sure to join my free Telegram community with the link on my channel where I post my daily crypto experience and arbitrage opportunities you can't get anywhere else. This is XRP Hobart signing off.